The first modern stock was issued in 1602 by the Dutch East India Company, forever changing how we build wealth.
Today, traders choose between individual stocks and market indices, but the differences are fundamental to your strategy.
A stock, or equity, is a security that represents a direct ownership stake in a specific corporation. When you buy a share, you aren't just betting on a price. You are becoming a part owner of that business.
As a shareholder, you have a legal claim on a portion of the company's assets and its future earnings.
These shares trade on global exchanges, with prices shifting based on company news, earnings, and investor sentiment. Ownership is the first pillar. Your financial success is directly tied to the success of that one specific entity.
Many companies also pay dividends, which are a share of the profits distributed directly to you, often every quarter.
Beyond money, you often gain voting rights, allowing you to influence corporate policies and board elections. While individual stocks offer the highest potential for explosive growth, they also carry the highest risk of total loss.
Indices, on the other hand, offer a broader perspective by looking at the market as a whole. An index is a statistical measure that tracks the performance of a specific basket of stocks.
Think of it as a barometer for the market's health, showing how a whole sector or economy is moving. You've likely heard of the S&P 500, the Dow Jones, or the NASDAQ. These are all major market indices. Indices represent segments like the top 500 U.S. companies or the entire technology sector. They act as benchmarks, helping you gauge if your personal portfolio is beating or trailing the general market. The biggest advantage here is diversification, spreading your capital across hundreds of companies at once.
When we compare the two, the primary trade-off is between concentrated risk and broad stability. A single stock can crash on one bad news report, but an index is rarely sunk by the failure of one member.
The trading mechanism also differs. You buy stocks directly, but you access indices through ETFs or index funds. Indices are influenced by macro trends like interest rates, while stocks react to internal management decisions. In practice, if you have a high risk tolerance and deep research skills, individual stocks might be your focus. If you prefer a set-it-and-forget-it approach with lower volatility, indices are often the better foundation. Regardless of your choice, success depends on aligning your trades with your personal financial goals. Remember, stocks are for precision and high stakes. Indices are for broad exposure and steady growth. In our next lesson, we'll explore leverage and margin, tools that can amplify your results, for better or worse.